Negative 1,153. That's exactly how many points the Dow just plunged, as global markets completely cracked under the intense pressure of an unexpectedly hawkish shift and mounting geopolitical fears.
Hello everyone, welcome back to AI Market News. Today, we're going to unpack exactly what caused this sudden burst of extreme volatility across equities, and more importantly, we'll explore what this means for all of us as Japanese investors navigating these turbulent waters.
According to current market information, the FOMC voted 9-3 to hold the federal funds rate steady at a range of 3.50% to 3.75%. But honestly, the critical detail here isn't the hold itself, it's the dissent. Three Fed presidents, Hammack, Logan, and Kashkari, actually broke ranks, pushing forcefully for a 25 basis point hike instead.
To understand why the market reacted so violently to this, we need to look at what a hawkish dissent actually means. When central bank officials push for higher interest rates during a planned pause, it strongly signals that borrowing money will likely remain expensive for a much longer period. This dynamic slows corporate growth and weighs heavily on stock prices, simply because companies face higher costs to fund their day-to-day operations.
And as you can see in the chart, the reaction in U.S. Treasury yields was incredibly sharp. Following the decision, Chair Watershute outright refused to commit to a September hike during his press conference. Because of that, OIS, or overnight index swaps, pricing is now dropping to just a 65% probability for a September move, and that shift is rippling right through the bond market.
Shifting over to commodities, the graph shows WTI crude oil rapidly surging past $83 a barrel. This massive jump immediately followed recent statements by the U.S. president regarding Iran, which instantly reignited geopolitical fears and serious supply concerns across the energy sector. So why does this sudden surge in oil matter so much to the broader market? Well, rising oil acts as a primary mechanism for cost-push inflation. Basically, this is a situation where everyday goods become more expensive simply because the raw materials needed to make them cost more. This terrifies the Fed, as it practically forces them to keep interest rates high even if the broader economy is slowing down. The fallout in U.S. equities from all this was immediate and severe. As you can see in the chart, this toxic cocktail of hawkish dissent and soaring oil fears absolutely hammered the Dow. It drove the staggering 1,153-point drop we mentioned earlier, with the index closing down 2.19% at 51,594. And the technology sector fared no better. The graph shows the Nasdaq falling 1.74% to 24,443. This marks its sixth straight loss, officially dragging the index into correction territory, which simply means a 10% decline from its recent peak. At the exact same time, the SOX Semiconductor Index, which is a critical barometer for tech, plunged an even steeper 5.3%. However, contrasting the US and Japanese markets paints a very different picture. While the S&P 500 dropped heavily, the Nikkei actually managed a 784-point bounce. But we have to be careful here, because this lift was highly concentrated. It was driven almost entirely by a massive earnings beat from a single component, Advantest. To understand the real strength of the Japanese market right now, we have to look at a mechanism called market breadth. Despite the headline index rising, more individual Japanese stocks actually declined than advanced during the session. This tells all of us that the overall market is structurally much weaker underneath the surface than that impressive main number suggests.
Before we wrap up this explainer, we need to check our economic calendar. We're preparing all of us for a very crucial block of data hitting at exactly 8:30 a.m. ET today. We'll be seeing the simultaneous release of Q2 GDP, weekly jobless claims, the Bank of England rate decision, and perhaps most importantly, the June PCE core deflator. Now, the PCE core deflator is practically the ultimate trigger for the Fed, as it's their preferred gauge of inflation. The underlying mechanism here is straightforward. A hot reading could easily push September rate hike odds back above 80%, causing even more equity selling. On the flip side, a cool reading might provide some much-needed relief and spark a tech rally.
Finally, as Japanese investors, we are focusing heavily on the upcoming BOJ decision and Governor Ueda's press conference on Friday. As you can see in the chart, the USDJPY pair is currently consolidating. It's coiled up and poised for a massive directional move based entirely on what the central bank decides to do.
Let's look at the currency mechanisms simply. If the BOJ decides to hike rates,
Japanese assets suddenly become more attractive because they offer higher yields. This would naturally strengthen the yen, potentially pushing the pair toward the 160 level. Conversely, if they hold, the yield gap remains extremely wide, and the yen could easily weaken back toward 164.
To summarize this volatile cocktail, the Fed held, but the hawks are circling, and oil is surging. With central banks pulling in entirely different directions, the big question is, are we standing on the edge of a new geopolitical market shock, or is this just a temporary summer storm? The next 24 hours of data will undoubtedly set the direction for August. Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.